Vamos lá.
Okay, vocês todos estão conseguindo ver meus slides, né? Perfeito. Eu vou switch agora para inglês. So thanks very much for inviting me to present the paper. Let me tell you that even though the paper, I actually wrote it about a year ago, we didn't have much time to actually progress after that. So we are actually doing most of the revision right now. So your comments actually have high marginal value because we are sort of like trying to implement a lot of changes to the paper right now. So the way I like to start presentations is I want to give you like a big picture of what this paper is about. So there has been, as you all know, there's tremendous number of papers that have studied the equity premium, right? The returns of equity markets relative to some type of risk-free asset. And over the more recent years, what we also have seen is a growth in the literature that people refer to as the equity term structure literature. So let me put everybody on the same page. So let me explain what this is. So an equity index pays the dividends that are going to be, paid forever, right? For going forward. But you can also think of contracts that would pay single dividends. For example, right now you could enter a contract that will pay only the dividend that you will get from, let's say, the S&P 500 in a given year, let's say 2022. So if you could buy that particular contract, you would be receiving the premium associated with that particular.
Andrei, you are in the mute. At least I cannot hear you.
Can you hear me now?
I can hear you now.
So nobody heard anything that I said so far? Oh, great.
The last 20 seconds, I guess.
I don't know why you muted. Oh, okay. Anyway, so let me step back. So did anybody hear the word the equity term structure when I said it or not? Okay, fair enough. So what I was getting at is that there is a growth in this equity term structure literature. And what I was trying to make sure is I want to make sure that everybody's on the same page. So the same way that we can study an equity contract, which will pay all dividends going forward for a given index, let's say the S&P 500, you can also look at contracts that will pay single dividends. For example, right now you could buy the dividend that the S&P 500 will pay just in 2022. So that's a single dividend, right? And what the literature has realized is that the equity premium can be written as a weighted average of the risk premium of each one of those contracts. The contract that will pay the dividend in 2022, then in 2023, and so on. And there has been a large exploration of this, and people refer to it as the equity term structure. The reason why the literature took off is because original findings show that the premium over the relatively short term seemed to be much higher than implied by models, and over the long term, much lower. What would that mean? Well, that means that most of the risk embedded in equities would be in the short term, not the long term. And most models imply the opposite. So there was a lot of interest in this type of evidence, and the literature took off from there. Okay, so that's some of the background there. So what I'll do in this paper, we'll do a few things, but before, let's just add and subtract here the return on a bond of the same maturity as the equity. So we can decompose the premium on a given maturity, and I will start calling those the dividend strip risk premiums. That's how people refer to those. So this is a dividend strip risk premium. So you can sort of like decompose those into a premium associated purely with the cash flow with no term premium component by subtracting a bond of the same maturity or the same age. And the term premium that comes from the bonds. Those ones we are very used to, just the interest rate component, right? Longer term interest rates are higher. And we'll do three things this paper to add to this literature. The first one is that we'll extend the equity term structure literature evidence to a much earlier period. Let me tell you why. So remember that I told you that there are these ways to build contracts that you can sort of like recover this dividend strip. This is done with derivative contracts, and they had not been trading for a long time. So they started trading around 2000s, a little bit earlier, but most of the data is from there. And they have several frictions, right? They may be liquid, they have trading frictions. So there are several issues with those contracts. And some of the literature has criticized the original evidence on this equity term structure literature because of it, because of the frictions associated with trading those contracts. So one thing that I'll do is I'll provide you a methodology that will allow me to explore the equity term structure literature on an earlier period without ever looking at those tradable contracts. And I'm going to show you how to do that. So that's the first thing that this paper will do. Second, I'm going to extend this logic to commercial real estate. So all the literature is based on equities. And I'll extend this to commercial real estate. Again, I'll explain to you how I'll do that. And finally, and perhaps the most important contribution of this paper, is that I'm going to study basically the co-movement between this component here and this component here. The first one is the pure cash flow risk premium component, is the risk premium that is associated with the cash flow after you remove any term premium component, any duration effect. Whereas the second one is a pure duration effect, right? So you have longer duration, so you have a different risk premium. And what I'm going to show, interestingly, is that in the market, those things are negatively correlated. When people are willing to pay a higher premium for cash flow risk, they're actually willing to pay a lower premium for duration risk. And I'm going to show you that this is the case. So those are the three core points of this paper. But now I wanted to briefly, highlight what type of methodology I'm using, because I'm telling you that I'm going to be able to sort of like extend this literature to earlier periods. So, how can you do that? There's going to be a key assumption in my paper. And the idea is actually fairly simple. I'm going to argue the following. If you build an SDF, a stochastic discount factor, that prices portfolios that are sorted on cash flow duration. Remember, duration that we teach our students, apply for bonds. You can apply that to equities and real estate as well, and I'm going to show you how to do it. But if you build portfolios that are sorted on that, and you build an SDF that perfectly price those portfolios, then intuitively, that SDF should be a good way to extract the implied prices on cash flows of any material. That's the idea of this paper. I'm going to produce those portfolios. I'm going to create an SDF that perfectly prices those. And then I'm going to use the techniques of the non-arbitrage literature to basically get the implied cash flow strips, or the risk premium on those cash flow contracts. And then I'm going to study those. Okay, where is this coming from? This actually comes from a prior paper of mine. So I have a prior paper that is on just constructing these cash flow duration portfolios. And one thing that I observed in that paper is that if you sort and these are equities, okay? So those are stocks. If you sort stocks on portfolios based on cash flow duration, it turns out that the longer duration equities, they are more exposed, these are betas, on the equity term structure. So the equity term structure here is proxied by the S&P 500 minus returns on a short-term dividend contract. So the longer the duration of the portfolio, the more exposed that portfolio is to the term structure. And that's something that I show in a prior paper, and you can do this in many different ways. You always get the same result, okay? So you can measure the term structure returns in several different ways, you get the same result. So this to me says that if you are able to price these portfolios well, then you recover the term structure. And that's the underlying idea of this paper. Okay, so that's the core idea. So what are the core results? I like to preview my results before I show them, because oftentimes I don't have time to go over everything. So there are really two key results. The first result is that what I call the maturity matched risk premium, that's the risk premium on dividend strips of different maturities relative to the bonds that have the same maturity. That term structure is hump shaped, and that's what you're seeing here. So in red, you see the equity term structure, and in blue, you see the real estate term structure. So I'm going to construct those contracts. I'm going to extract the risk premium on those. And on average, you see this hump shape. What does that mean? It means that equities over the short term, they pay, or the mid term, let's say, around here, like 5-10 years. They pay relatively, high returns in comparison to equities over the long term. So the risk premium associated with cash flows seem to be much more relevant for the short term. Investors seem to care about short-term cash flows risk, and they don't care as much about long-term cash flow risk. Okay, that's what this says. And that's true both on equities and on real estate. The second key component is that these two terms, the risk premium associated with the purely cash flow with no duration effect, and the risk premium associated with just duration, just the bond duration, they are negatively correlated. And that's what you can see here. Here in black, you see basically the bond risk premium. And in red and blue, you see the equity and real estate cash flow risk premium after matching on the duration, right? After extracting the term premium component. And they're strongly negatively correlated. I chose the 30-year here for this graph, but you get the same picture pretty much any horizon that you choose, okay? Those are the two key results of this paper. I'm going to argue that this result in particular may have implications to models that are beyond what we know currently in direct term structure literature. That's where we want to go going forward in this paper. We want to understand what portions of structural models that we know of in asset pricing we can invalidate given this negative correlation. Okay, we don't know that yet in this paper, but that's where we are heading to. All right, so that's the big picture of the paper. To be frank, at this point, you can all go browse your email that you already know the entire paper. But there are a lot of details, so I hope you stick around, and so that we can go over together over all of those details. Okay. All right. So let me start by introducing the no arbitrage model. Basically I'm going to specify some dynamics for state variables and the SDF that I'm going to use. First, I'm going to say that there is some state vector that is composed of excess returns. Every time that I put an X and an R, I mean excess returns. So some return relative to the risk-free asset. So there's some excess returns and some set of state variables, which will be market yields later on. And I'm going to assume those follow a regular vector autoregressive system. Okay, so it's a first order vector autoregressive system, so nothing fancy here. And what I'm going to do is I'm going to say the SDF can be recovered as a projection onto those returns. Okay, that's a standard approach that we take in the vector model literature, for example. We recovered SDF from returns. And if you do this, the 1 year bond is known beforehand, that's a treasury. So that can be embedded in the expectation of the SDF. And the rest becomes sort of like a shock. Whenever I put a tilde on the top of a variable, I mean a shock to that particular variable. Okay, so it's the variable minus its expectation. Okay, so that's my SDF. And I'm going to make an assumption that there's a subset of those returns that price all of those returns. And I'm going to be more specific on what this assumption means. So there are 3 key identifying assumptions in my framework that I'm going to rely on. The first one is that this state vector is the only reflects all the variables that matter for the dynamics of expected returns on those portfolios. So just a preview, this XR here will reflect excess returns on duration sorted portfolios later on. Okay, so I'm going to argue that this ST is going to be all you need to know to get those expected returns. The second assumption is going to be that these returns, these duration sorted portfolios, they span the space of mimicking portfolios for S. That's just a mouthful for something very simple. All I'm saying is that if you want to understand the risk embedded in this S variable, you don't need to actually look at S variables. You can just look at the returns themselves. And what is the intuition that's going to come out here? I'm going to use yields in the S variables. Think of this as the interest rate, for example. Then portfolios of bonds of different duration are going to capture movements in the interest rate. So that's the idea here. And I'm going to show you how exactly this is done. And the third assumption is what I just said, that you have a subset of these portfolios that prices all the portfolios. Those are going to be 3 identifying assumptions. I'm going to try to validate them, at least to some extent, and then I'm going to derive the implications of those. All right, so now let's move to defining what exactly goes inside this XR and what exactly goes inside of this ST. Okay, so here's our 3 identifying assumptions. What we have, and this is a requirement, we have to have the yields on the 3 asset classes that I want to study inside the ST variable, the ST vector. And this is just the 1 year bond yield. Think of this as the 1 year interest rate. This is the equity yield. Think of this as a dividend price ratio. And this is the real estate yield. P here reflects properties. That's why I use the letter P here, properties. So this is equivalent to the dividend yield before real estate assets. Similarly, I need the equity market index and the real estate market index to be inside the R vector. Okay, so those are our requirements for my framework. So what am I going to specify? I'm going to say I'm going to use the minimum amount of deviations from this baseline that allows me to work through my model. So the first thing that I'm going to do is I'm going to say the S vector is composed only of yields. This is the 1 year interest rate. This is the term spread, right? The spread between the 15-year interest rate and the 1 year interest rate. And those two are the dividend yield and the equivalent to a dividend yield in the real estate market. So those are going to be my state variables. I'm going to use portfolios sorted on duration in the bond asset class, equity asset class, and real estate asset class. S here stands for short duration. L stands for long duration. And the one that does not have an upper script is the market itself. That's the equity market. Think of this as the S&P 500, for example. Similarly, for real estate, I'm using REITs, real estate investment trusts. S is the short duration, L is the long duration, and this is the whole market. And these are just bond portfolios that are very standard in the literature. So, and the last one is that I'm going to assume that a level and a slope factor, they perfectly price all of those. Okay, and I'm going to validate this assumption. Go ahead.
Andrei, are you going to say something about how do you attribute different durations to different equity portfolios?
Sure, I can do that. Thank you. This comes from my private paper, so it's not a contribution of this particular paper, but let me show you how I did, okay? But you shouldn't see this as a contribution of this particular paper. It comes before. So how do we actually construct this portfolio sorted on duration? So in general, remember when you go teach your students, duration is just a weighted average of cash flow maturities, right? There's some weights here, and there's some maturities which I'm proxying with age. The weights are the value of each cash flow component, right? So it's the cash flow discounted to present value. The DR here is the discount rate, divided by the value of the asset. The weights have to add to 1. That's a constraint on weights. What I'm going to do, so for bonds, that's obvious, right? The cash flow of a bond is a $1, right? So you already know this guy. The discount rate is just the yield to maturity, and the V is the value of the bond. So you can easily calculate this thing. That's what we teach our students. I'm going to extend that logic to equities and real estate. How am I going to do that? I'm going to define cash flows to be payouts, meaning dividends plus repurchase minus issuances. Those are going to be my cash flows. Given that those are the cash flows, the value is the market equity of the firm. And this restriction that awaits add to 1 imply a valuation equation, meaning the market equity of the firm must be equal to the discounted value of all future payouts. Okay, so how am I going to extract duration from this? I go at the firm level. I estimate a vector autoregressive system at the firm level, and that's going to allow me to predict cash flow next period, right? But because the vector autoregressive system, we can compound that over multiple periods to predict the cash flow 2 years ahead, 3 years ahead, and so on. So I derive in my other paper closed form expressions for this blue term here, the expectation of payouts going forward, given a vector autoregression at the firm level. Then I estimate this VAR, this vector autoregression, each period using past data. So it's an out of sample exercise. Each period I look at the past data, estimate the system, predict these cash flows. So I have out of sample estimates for cash flows going forward up to infinity. Okay. Once you have those cash flows, you can observe market equity, right? So you can use numerical techniques to solve for this green term here, the discount rate, that satisfies this equation, meaning that makes the current market equity to be the present value of future cash flows. So you can solve for this numerically. That's what I do at each firm, each point in time. Once I have those green terms, I have those blue terms, and I know the market equity of the firm, I can plug in all of these things right here.
Sorry, Andrei, how like for this to solve for the green stuff there, don't you need more assumptions on how the R evolves over time?
Yeah, so this is a good question. So here I'm going to basically use a constant discount rate per firm. Okay. So I don't need the assumption how the expectorants are going to move over time, but what I'm solving for is the long-term expectorant. That's called in the accounting literature the ICC, or implied cost of capital. So that's what I'm solving for. But that's a good question. So once I have this green term, I have the blue term, I have the red term, I plug in everything here. That gives me the weights for each firm at each point in time. I'm now able to calculate duration. So at each point in time, for each firm, I have a duration measure. After that, I just use the typical portfolio sorting exercise that everybody uses in the literature, okay? And that allows me to build portfolio durations. For real estate, I do exactly the same thing, except that instead of applying to equities, I apply to real estate investment trusts, or REITs, okay? But the idea is the same.
Sure.
Does that answer your question, Ricardo? All right. Great. So so my returns here, and the idea is very much on the following. Because I have this portfolio sorted on cash flow duration, if I price them, I should be able to recover, important information on my cash flow strips. And that's the idea of this paper. Okay, great. So we have this structure here. Now let's try to understand how we estimate the model. So the regular Euler condition that the SDF has to price any excess return, we will imply a beta factor model, right? This is just very standard. But then because of the implication, because of the structure of my SDF, this can be written as the covariance of returns and this term here, which will capture the risk prices. But remember, I specified a VAR in the very beginning for my returns. So this is linear. But this is linear, this is a constant that must imply my risk prices are linear. Okay, so they must be linear in Z. Moreover, if you go through the algebra, you can derive restrictions on those risk prices. And it's possible to write those restrictions as a panel regression, in which the right-hand side are just returns, and the left-hand side is a bunch of covariances with the risk factors. I'm going to use the terminology risk factors, even though there's no presumption that this XR really reflect risk. This is just a no-arbitrage model, okay? I'm still going to call them risk factors. So those are the covariance of risk factors. Hey, if you look at this, that should remind you of typical Fama-Macbeth regressions, in which we have some covariance on the right-hand side, we have some realized returns on the left-hand side, and we can estimate all of this. The only difference is that this blue term here itself depends on the red terms. So how do I do this? What I do is I start from a consistent estimate of the sigma matrix, the covariances, by just estimating the VAR by OLS. Once I have that consistent estimate, I plug in that on the right-hand side. That gives me all my covariances. I run a panel regression, okay, which allows me to estimate the red terms. Once I have the red terms, I go back to these restrictions. I now have an estimate for the sigma. I have an estimate for the red terms that allows me to recover the other blue terms. And finally, I can update my sigma. Marcelo.
Just to clarify, when you estimate your sigma, you are essentially assuming that it's conditionally almost stochastic?
Yeah, so that's going to be one assumption in my framework. So one of the assumptions of...
Yeah, which is fine. So you're working here with monthly data, not daily data.
I'm working here with annual data. So
annual.
Actually, let me be more precise. I'm working here with monthly observations of annual flows. I have monthly data, but result annual flows, annual returns, and so on.
Okay.
So I agree with you that at a short horizon, volatility varies a lot. Over the long horizon, it varies less.
I'm fine with that. No problem. Just to clarify.
Sure.
Andrei, just a point to make sure I'm following. Your XR star is like what Cochrane calls the RE star, yes, the projection of one on the excess return space.
Precisely.
Something like that.
Is the projection of the SDF on the excess return space with a restriction that I'm going to force that projection to be just a level factor and a slope factor for each asset class. But I'm going to show you that this is a good assumption. Okay, I'm going to show that that's the one assumption that I can validate very well. The other two are a bit more tricky. Okay, so that's how I estimate it. Bear with me. I know there's a lot of technical details to get this thing going, but once it gets going, it produces interesting stuff. Okay, so once I have that, it should be no surprise to anybody familiar with the term structure literature that once you have an SDF and you have cash flow dynamics, you can recover term structure behavior. So meaning if you define bond yields in the regular way in which we always define bond yields, then it's going to be all linear in my state factor. Okay, similarly, expectorants are going to be linear in the state factor. You can do the same type of tricks that the bond term structure literature use for equities. So we define equity yields that becomes linear in the state factor. Then you get expected returns that are linear. And the same for real estate. Okay, so the challenge is not really here; it's on the estimation of everything that I showed you before. Is the specification of the model, the estimation. Once you have that, you can derive term structures for all three asset classes. Okay, great. So now my goal is to validate the model so that you can trust whatever I'm going to show you later. Okay. So the first thing here that I want to validate is this assumption here. Just as Ricardo just asked, I'm making an assumption that there's a subset of returns that prices all those duration sorted portfolios. Okay, and the subset is a level and a slope factor per asset class. So let's see how well that works. What I'm showing you here is the model implied expected returns, and on the y-axis, the actual average returns on those portfolios. And you have the bond portfolios, the equity portfolios in red, and the real estate portfolios in green. And as you can see, with a two-factor model, two per asset class, you actually price those very well. You would not price those very well if you were to use a CAPM. Okay, this is a conditional CAPM, that would be pretty bad. If you were to use one factor per asset class, that would also not work well. Okay, so just the level factor per asset class. But with the two, it works very well. You can do even better by having three factors per asset class. I do this in my internet appendix as a robustness. You get pretty much the same results. So I work with the more parsimonious model. Marcelo, your hand is still raised. I don't know if you still have a question or.
Right. I do. Okay. So I was raising my hand, physically. I forgot completely about the virtual one. So it did this, like when, as an econometrician, whenever I look a linear regression like the three-factor model one, where everything fits so perfectly, my first reaction is something is wrong, something is fishy here. But I don't want to go into there because it's an internet appendix. I don't think it's worth discussing. So let me go back to the two-factor model, and it seems that once you account for the two factors for the other assets, like just imagine like term structure of interest rates, we know that we need three factors. If you do like term structures of everything you can think of, like three factors is essentially the rule of thumb. And what you're saying here, well, at least what I'm seeing here is that you don't really need that curvature factor. The curvature is actually capturing the factors from the other assets, from the term structure of the other assets. Is it valid, this interpretation? Because in some sense, equity is looking at long term, and it could be something related. So.
Yeah, so what you are referring to is that in the bond term structure literature, almost everybody agrees that we need those three factors, right? The level, slope, and curvature. And you're saying, come on, you're showing me that two factors price well bonds? How come? The reason is I'm only showing you here the unconditional pricing of those, right? I'm showing you on average they price well. At any given point in time, yields may deviate. I'm going to show you the deviation. There's going to be a little bit of deviation there. And that's what the term structure literature is about. So the bond term structure literature is about getting the yields very, very, perfectly. And for my paper, I believe that econometrics is a useful tool to be able to derive things. But if you try to be too perfect, maybe you're overfitting things. That's why I end up with the two-factor model as opposed to three. But sure, if one wants to perfectly price the yields at each point in time, meaning a conditional pricing, one does need the three factors, just like the bond term structure literature suggests. But it turns out that for my results, it doesn't matter. You get the same results in both ways. But you're absolutely right. And I'm actually going to show you this in a couple of slides. Okay. So we validate this, and in the paper I have a lot of extra graphs showing that they conditionally, each point in time they also price well the portfolios. So we validate the third assumption, but we have these other two assumptions here. They're very hard to validate because the key is that it's impossible to know all the possible state variables that could drive the expected return dynamics of duration portfolios. It's very hard also to make sure that there's no way in which this S reflects risk not embedded in R. So it's very hard to do it. So instead, because I cannot directly validate those, what I'm going to show you is that even though I never use dividend strip data to estimate the model, they're going to capture the general behavior of dividend strips in the data. And this can only be true if the model roughly captures the essence of the cash flow strips. So that's what I'm going to show now, and this perhaps where I can also give an answer to Marcelo. So here, before I showed you the unconditional pricing of those things, right? Right now, what I'm showing you here is the yield, like the 5-year bond yield at each point in time, implied by the model and in the data. And the model priced very well, but you see there's some periods in which there's mismatch between model and data. That's what the term structure of literature on bonds is about, is capturing all of those points very well conditionally. My model misses some of those movements. You see that the black line deviates from the red line once in a while. for my purpose, I don't want a perfectly priced yield, so I'm good with that. But if you care about the perfect pricing, go to the three-factor model. It's in the internet appendix. It prices these things better. Now, what I care the most is actually this one. So notice I never use dividend strip data. Remember that I told you there was ways to using derivatives to construct dividend strips and so on. I never used that at all. But here is the equity yield on a 1-year equity strip constructed from derivatives data. And that's what is implied by the model. So what you see here is that the behavior of those contracts are exactly showing up on the model implied dynamics, despite the fact that I never use that data. They spike up during recession and they move up and down there. Moreover, if you look at a term structure, you're going to see that the dynamics are also in there. For example, if I move from 1 to 4-year, they become smoother, both in the model and in the data. The same goes if I move further to the 7-year. So the dynamics of equity strips, or sorry, dividend strips, they are well captured by the model. Why do I care about that? I care about that because people have argued that the black line here, the data, is full of microstructure noise, illiquidity, problems that make the use of that data unreliable. And I'm arguing here that not so much, because I'm actually taking data from equities, no illiquidity issue on my portfolios, they're all valuated. Yet, the dynamics of the yields that are implied by those equity portfolios actually reflect pretty well the dynamics that you observe in derivatives market. So it seems that frictions do not drive the dynamics of dividend strips in the equity markets. So that's the first thing that I want to point out. More broadly, for the purpose of this talk, I care about this because that should give you some confidence that the results that I'm about to show you have, even though they come from a model, a non-arbitrage model, they are reliable because they actually reflect the data over the period in which we have data at. But of course, I'm able to extend the red line up to the 70s, whereas I'm not able to extend the black line up to the 70s. And that's how I'm going to extend the equity term structure literature to the data in the 70s and not have to focus on the period that people have criticized for being short. Are we all good with sort of like what is being done here? Okay, cool. So now that I validate everything, we can move to the main results. And the first result that I want to point out is that excess returns, whether you look at equities, bonds, or real estate, they are increasing over time. So there's an upward slope in term structure. But those are nominal cash flows, right? Those are nominal bonds, nominal dividends. So a component of those cash flows is just about the term premium that is embedded in nominal bonds. So if you want to understand the risk associated purely with cash flows, with no term premium component, no duration effect, you have to subtract the bond returns from the equities or the real estate. That's what the second graph shows. And what you have is a hump shape. So we have been, for a long time, we have been focused on this. When we talk to our students, we say the long term is very risky, right? But in reality, it's not about that the cash flows in the long term are very risky, because they're not. If you extract the term premium component, they're not that risky. So whatever risk we have over the long term is present even on fixed cash flows, even on bond cash flows. Okay, so it's not about the risk of long-term cash flows that induces high discount rates over the long term. It is about something fundamental about bonds. Okay. So that's the first thing that I want to show, and that graph is applying up to the 70s. So I'm able to use data up to the 70s to get this graph. So that's the first result. The second one that I want to show is something that I find interesting. So we are very used to look at yield to maturity, right? So I have a yield to maturity on bonds here, at a 2-year bond, a 10-year bond, and a 30-year bond. And we all know that yields are much more volatile for short-term maturities than they are for long-term maturities. So long-term interest rates, they move slowly, whereas short-term interest rates, they're more volatile. This is the typical result. So that's what you're seeing here. Turns out that when you look at one period ahead risk premium, it's exactly the opposite. Short risk premium on short-term bonds, they're not that volatile. Okay, but risk premium on long-term bonds are very volatile. What does that mean? It means that this smoothing effect of long-term yields is mostly coming from mean reversion, the expectation hypothesis effectively. The risk premium itself is actually much, much more volatile for long-term strips. And this result is not only true on bonds, it's true on equities, as well as on real estate. The same type of result is there, meaning the yields are a smoother over the long term, but the risk premium is actually more volatile for the long term. Okay, so that's the second key result of this paper. Again, I don't want to claim that this is the first paper to show this result. People have explored this over the short sample that we have for dividend strips. People have explored that. There's a paper in JJF by Niels Gormans in Chicago who shows this over the very short period that we have dividend strips. What I'm doing is extending that analysis to a much longer period and to different asset classes. Okay, so those results are there. Okay, and the third result that I want to show, and that's entirely new in this paper, I'm not aware of any paper that has shown this, is whether in a short period or not, is that when you look at the risk premium on the nominal cash flows, they co-move, right? They're very strongly positively correlated. Yet, when you look at what I care about, which is the risk premium on specific to the cash flows, after you extract the term premium component, and you look at the co-movement between those and the term premium of bonds, they're actually negatively correlated, not positively correlated. So that necessarily implies that whatever model is true in asset pricing must have a very different dynamics on the risk premium associated purely with cash flows and the risk premium associated purely with a term premium component, inflation type of effect. And that I think that's a key result. I chose here a 30-year maturity, but that's very general. This is just showing that the same effect happens on slopes, but let me show you the graph that shows that's not only about the 30-year maturity, it's pretty much all maturities. So what I'm showing you here is the following. For each, I showed you before, the negative correlation between the risk premium on cash flows after you extract the bond premium component and the term premium component on bonds, right? And I chose the 30-year maturity to show that correlation. Now I'm showing for each point in the correlation in the maturity spectrum, I'm showing you the correlation between bond and equity in black, bond and real estate in red, and equity and real estate in blue. And what you see is the following. Basically the risk premium on cash flows, they co-move positively with each other. That's the blue line. The risk premium that is purely due to cash flows between equities and real estate, they're quite positively correlated. But the risk premium on the term component, pure duration risk premium, which comes from bonds, and those two cash flow risk premium, they're actually negatively correlated. So that's the same result that I was showing you before, but for all the maturity spectrum of the term structure. And similarly, you can show similar results for the slope of the term structure, but that happens more over the long term than over the very short term. Marcelo?
I'm just asking my daughter not to make noise, sorry.
Oh, that's fine, you're good. Okay, so those are the central results of the paper. I prepared the presentation to finish in 45 minutes, so we are almost there. Let me just tell you that everything that, look, every time that you write down a model, there are assumptions that you have to make. And this is no different, okay? I have to make several assumptions to get this going. I believe that those assumptions are useful to progress the literature. But now what I'll try to argue is that many of those assumptions, at least the ones that I explore, they are not that important for the core result that I have. So, okay, so I did not actually tell you before, but I use some log linear approximations to get those linear dynamics because I like linear stuff. It's beautiful. So, but turns out that you can derive exact dynamics with no log linear approximation. They're just ugly. Okay, the functions are all ugly. So I derived those. If you look at the results, they're pretty much the same. So they go to internet appendix. I prefer the simplicity of the linearity there. I use a very, if you remember, I had a panel regression, and I use a very simple method to estimate that. Well, as any econometrician knows, panel regressions can be much more efficiently estimated once you account for the dynamics of the covariance matrix to use GLS type of approach, right? So I do that as well, and you get similar results. As I mentioned before, you have, the three-factor model fits the data a little bit better on the duration sorted portfolios. It turns out that in terms of the implied term structure dynamics is very similar. So I kept that in the internet appendix. So that's the third point here. And there's one that I actually want to show because that's something that people always ask me. If you go back to, so let me just show you this picture here. If you go back to this graph, you notice that for most of the sample, the interest rates are declining, right? So that is being true in the US. Nominal interest rates have been declining since the late 70s. And a lot of people have asked me, so are your results, somehow affected by that? Maybe they're only coming from a period in which interest rates are overall declined. There's a secular trend, and maybe those somehow drive your results. So one thing that I did, unfortunately, I do not have data on real estate before the 70s, but I can do the analysis for equities at least, okay? Starting on the 50s. Oops, oh, it was for some reason, did not work that well, okay. So, and if you do that, you get the same dynamics, meaning there is a hump-shaped term structure that is unconditional, and the correlation between the risk premium on bonds and equities is all negative. But starting on the 50s, there is a full movement. You have like interest rates going up from 50s to the 70s, and then going down from 70s later on. So that's not about the decline interest rate that is driving this result. It's not the case. And I also have results removing the real estate stuff, because people get very skeptical when they hear about real estate. I don't know why, but they're like, oh no, maybe our real estate variables are driving this result. I have some results in which I fully remove all real estate stuff. It's all there. Okay, so that's 3:45. So I should not, extend my welcome. So the conclusions are the following. So first,
you can take longer. It's very interesting. So please take your time.
I'm happy to hear some questions as well. But so the basic idea of this paper is simple. I start by saying I want to build an SDF that prices bond, equity, and real estate portfolios sorted on cash flow duration. And I basically mechanically construct this SDF to price those portfolios well. I'm not arguing that that's a contribution in itself, but rather I want to argue that once you price those portfolios well, you can learn something about another type of contract that we don't observe in the data, and those are these cash flow strips, and that's the point of this paper. So using that SDF, I obtain the implied bond, equity, and real estate cash flow strips. I extend the equity term structure evidence to a much earlier sample than people have done, and I extend the evidence to commercial real estate, which is an entire new asset class. So it seems that everything that you observe in the equity term structure is also there on real estate. And to me, one of the things that I find most interesting in the paper is that there's this negative correlation between the bond term premium component and the cash flow premium component. I think this negative correlation is very important and may be able to guide how we modify structural models, those deep economic models, going forward. That's the next step of this paper, actually. That's where we are trying to go at. And finally, this is the core. I think that inflation, bond really reflect inflation plus term premium. It's not clear how, which is which. So another thing that we want to do in this paper is disentangle the two. We have not done that yet. But that's fundamentally what this paper is about. Thanks so much for inviting, and I'm happy to hear questions and answer those.
Thank you so much, Andrei. So guys, please feel free to raise your questions, comments.
So, Andrei, you spoke about the stochastic discount factor. Obviously, it's a key piece in the puzzle that you're trying to solve, but it's an artificial one in some sense, and given that you are essentially trying to price bond, equity, and real estate well. And perhaps let me rephrase that. What do you think would be the outcome if you try to use an agnostic stochastic discount factor, estimated from every asset in the economy, a little bit like Korachik has been doing? I think he has a journal of forthcoming paper, or perhaps is already out in Journal of Econometrics about that.
Yeah, so folks have tried to estimate SDFs in more agnostic ways. I struggle with that for the following reasons. So SDFs that are agnostic, they are very good for not taking a stand on what they need to price. But they might miss important aspects of the things that are not being used to price, right? And in this particular paper, I have a very, very targeted objective. And my objective is to understand the equity, real estate, and bond term structures. So what I do here, I agree that the SDF is artificially constructed to price those portfolios. But notice that that is the objective of the paper. The objective of the paper is to have an artificial SDF that gives us something that reasonably price those three markets in terms of the cash flow maturities. Because then I can add confidence that what we are actually obtaining from cash flow strips is reasonable. If I start from agnostic SDF, that may miss, maybe it prices very well, let's say momentum portfolios, but it misses cash flow duration, then it's a great SDF, but it will be meaningless from the perspective of my goal, which is to understand cash flow strips. Does that make sense? I want an SDF that prices one particular thing, which is cash flow maturity. That's all my SDF has to price. So long as my SDF does that very well, I'm good with it, because that's the only implication I'm going to derive from it. And so that's the way I view it.
Yeah, could you view your stochastic count factor as a projection of, some a little bit more general stochastic count factor in the space payoff?
Yeah, absolutely.
Where you're essentially.
Yeah, I don't mean to say that this SDF that I'm constructing is in any way deep. It's not. All it is a projection that focus on the assets that I care about. And the same way, I'm not arguing. So there's no sense in the world in which I'm arguing that this paper is about explaining duration portfolios. It's not. I have a paper on that. That's published already. So this paper is about understanding the term structure. So I'm almost taking as given the pricing of bond portfolios and equity portfolios and real estate sorted on duration to derive the cash flow. So here's one way to think about it. If you think about the way we use Black-Scholes model, we take as given the pricing of equities and bonds and dynamic trading of those to derive the Black-Scholes equation to price options, right? So we artificially construct, the one way to derive the Black-Scholes equation is to artificially construct the SDF that prices the dynamic strategy that moves towards bonds and equities, right? And once you have that SDF, you can understand something about options. There's no sense in the world in which the Black-Scholes model is explaining, the equities and bonds. It's not. It's taking that as given to understand options. I view my paper very much in the same light, meaning I build an SDF that prices very well the bond, cash flow duration, and then I use that SDF to understand a different asset that I unfortunately don't observe the data. If I did not observe options data, what I would be doing right now is taking, looking at equities and bond markets and trying to come up with artificial option data from the Black-Scholes model. If that sort of like explains what I have in mind. It's sort of like analogous.
I have one. Andrei, did you think about economic story? I mean, an anecdote to rationalize these patterns? I mean, when the term spread is high, the risk premium is low. Is there a story behind that? I mean,
yeah, I don't. So that's exactly what we are trying to do. It's so, in some sense, building economic. So this is not a deep economic model, right? It's just like the data effectively. So to have a deep economic model, my next step, and that's where we are going in this paper, is to try to understand how models such as Lethal Walker, for example, or long-run risks and all of those type of models. I think Lethal Walker is probably the best model because it's focused on term structure stuff. But my next goal is exactly to look at how this correlation look in those models and what mechanism induces that. Why do I want to do this? Well, if the correlation is positive there, the data that I'm showing here is going to tell us something about what is wrong in the mechanism of the model. If the correlation is negative in those models, what basically it's going to allow me to interpret my data through the lens of a model. So regardless of the way it goes, it helps me to either tell economic story or invalidate a particular economic mechanism in important models. So that's exactly my next step in this paper, and we are struggling exactly on that.
Can I push you to speculate on that? I mean, something like labor income.
Sure. whenever I have to speculate, I always go back sort of like to stuff that I have done before, perhaps because I don't have much knowledge outside of that. But you know, the way I think about these things is in the context of investment opportunities. And again, it's completely speculative. I have not estimated a structural model to say whether this would work. But the way I view this is the following. So if you think about the way the term spread moves, it's very well known that as the slope of the bond term structure moves around, investment opportunities, meaning expected returns on the market, move up and down. And those investment opportunities are priced by the market in the context of intertemporal CAPM type of models. So what you can have then is this first component here, which is the term premium, inducing variation investment opportunities, which are then reflected on the price of cash flow risk, which is this component here, and then induces negative correlation. Why? Well, because when the slope of the term structure here is up, you have low expected returns going forward here. So sorry, this is not the yield slope, right? So this is the risk, you know, the one period ahead slope. So it's different if you have that in mind. So when this is high, you will have low expected returns going forward. What does that mean? Well, it means a bad time from the perspective of a long-term investor. If I'm a long-term investor, I care about wealth growth. Periods in which expectations go down are bad news for me, and I price their risk. So that would show up as a opposite movement on the cash flow spread component. Now, I'm not suggesting that mechanism is actually going on because I have not estimated such a model, but that's one potential mechanism that could be there.
Good. I was here thinking about how about a situation where the appetite for risk is high, then the term premium, then the risk premium is low, but long-term interest rates are high because you expect something to, I don't know, the central bank to come and things like that.
But that's what is so difficult about this result. That's why I care about this result so much, is because this is not an interest rate, that's a risk premium.
Yeah.
So if you have appetite for risk premium, so for taking risk to be high, let's say people want to take risk, this should decrease as well. So fundamentally, you need to have a two-dimension risk premium evolving, because otherwise this doesn't work. And that's why I went back to the ICAPM, because in the ICAPM, what happens is the following: you have the think of like this, think of a model like in the spirit of Campbell-Cochrane, in which there is variation in the risk aversion. If you have an ICAPM, that's not the only source of risk pricing taking behavior in the market. The other source is the concavity of the value function with respect to the state vector. So if the concavity of the value function moves in the opposite way as the gamma, like the risk aversion, then you can have two things that are both risk premium components moving negatively with each other. And that's why I think one way to think about this is for the context of the ICAPM, because then you have these two components of risk premium, of risk prices moving around. But again, to make this statement something that is precise, you need a model. I don't like to make those statements because I have not done that. I have not estimated a structural model that takes very seriously the economic framework, the preference structure. I have not done that in this paper. I did this on my job market paper. And in the job market paper, I can tell you that I can explain. And so, you know, I like to talk about things that I know for sure. So for example, I can explain this pattern very easily in my job market paper. So in the mechanism is the following in my job market paper. So it's currently at the JF. So the mechanism is as follows. You have a long-term investor who cares about long-term expected returns. When expected returns go down, that's bad news for that investor, okay? But think about it, a short duration asset, when expected returns go down, it increases in value a little bit. But a long duration asset, when expected returns go down, increase in value by a lot. By definition, long duration means you're highly sensitive to expected returns, right? So that means that a short duration asset is not a good hedge for this decline in expected returns. Whereas a long duration asset is a very good hedge. So in equilibrium, the investors are willing to accept a lower risk premium on the long end, on long duration assets, than they are on short duration assets. So I can explain this hump shape here on my job market paper. It's exactly a hump shape there because this is not the only mechanism. The market risk is also there. So over the very short term, the market risk dominates. So you have an upward sloping. And on the long term, this mechanism that I just said, this hedging mechanism dominates, inducing a downward slope. So you get a hump shaped term structure. So this pattern here, I can explain to you with a structural model, well estimated, everything consistent, general equilibrium. But this negative correlation, I just don't have yet the model.
Thank you. Great. Well, I believe we still have time for one more question. Bom, parece que... Bom, Andrei, muito obrigado, excelente. Obrigado a todos por terem participado. Deixa eu só dar um recado. O nosso próximo seminário é 3 de dezembro com o Walter Novaes, da PUC-Rio. Muito obrigado, Andrei, obrigado a todos.
Obrigado pelo convite e obrigado por aguentar aí até o final, um monte de equação para tudo quanto é lado.
Foi ótimo, foi ótimo.
Obrigado.